Welcome to the Morning Bell. I'm Robert, and joining me as always is Lizzie. Today we're doing something a bit different. We've gone through almost 100 Outlook documents from JPMorgan and Goldman Sachs to compare their 2026 forecasts across the board. These are two of the most influential voices on Wall Street, and while they often agree on the broad strokes, the differences in their views can tell us a lot about where the real uncertainties lie. Lizzie, I have to say these documents are dense. Before we get into the weeds, what's your overall impression? Are these two firms basically seeing the same picture, or are we looking at fundamentally different views of 2026?
You know, Robert, it's actually more nuanced than I expected. On the surface, they're both calling for resilient growth, and they're both relatively optimistic. But when you dig into the details, there are some meaningful differences in their forecasts, and more importantly, in what they think is driving the economy. Let me start with the big picture on GDP. JPMorgan is forecasting US growth at 1.8% for 2026, which is exactly what they saw in 2025. They're expecting this interesting pattern where growth actually accelerates above 3% in the first half of the year, boosted by tax refunds from the One Big Beautiful Bill Act, and then slows down to 1 and 2% in the second half. Goldman Sachs, on the other hand, is more optimistic. They're calling for 2.6% growth on a Q4 over Q4 basis, which translates to roughly 2.5% for the full year. That's a pretty significant difference. We're talking about almost a full percentage point gap. Goldman is actually the most optimistic relative to consensus, which sits around 2.0%. What's interesting is that both firms see the same fiscal stimulus from tax cuts providing a boost in the first half. But Goldman seems to think the underlying momentum is stronger and will be more sustained throughout the year.
So Goldman is more bullish on the US specifically. What about globally? And what's driving their optimism?
Globally, Goldman is forecasting 2.8% growth versus a consensus of 2.5%. So they're above consensus there too. They're particularly optimistic about China, calling for 4.8% growth versus consensus of 4.5%. JP Morgan doesn't give us a specific global number in quite the same way, but they're generally aligned on the resilience theme. The key difference in Goldman's thinking is that they believe the tariff drag is going to be less severe than many feared. They note that the effective US tariff rate increased by about 11 percentage points since the Trump administration took office, but they expect that to decline slightly to around 9.5 percentage points in 2026. JP Morgan, meanwhile, is more focused on the one-time nature of the tariff impact. They see tariffs boosting year-over-year inflation through the first half, but then fading as a macroeconomic force in the second half, assuming no new tariffs are imposed. Both firms are also watching the Supreme Court case on IEEPA tariffs very closely. If those tariffs are ruled unconstitutional, Goldman thinks replacement tariffs would be capped at 15%, which would actually be a relief to the market.
Let's talk about inflation then, because that seems to be a critical piece of the puzzle. We've had this persistent inflation running above the Fed's 2% target. What are these firms expecting?
This is where things get really interesting. And it's one area where the two firms are fairly aligned, though with different emphases. JP Morgan expects year-over-year CPI to peak below 4% by June 2026, and then fall back to 2% by the end of the year. They're forecasting average inflation in the upper 2% range for the full year, which is moderately elevated. The key drivers they identify are tariff pass-through effects, which will be gradual, offset by lower oil prices and declining shelter inflation. They note that services inflation remains sticky because there's limited slack in the labour market. Goldman Sachs is looking at core PCE inflation, which they expect to slow from around 3% currently to near 2% by the end of 2026. They make an interesting point that if you exclude tariffs, inflation is actually running at about 2.3% right now. Both firms emphasise that the tariff impact on inflation will diminish sharply in the second half due to base effects. Essentially, once you're a year past the initial tariff implementation, it stops showing up in year-over-year comparisons. Goldman also highlights some disinflationary forces that JP Morgan touches on too. Declining oil prices, increased supply of goods from China, and faster productivity growth. That productivity point is crucial, and we should come back to it.
Before we get to productivity, let's talk about the labour market, because that's where I'm seeing some real divergence between these two firms. What's happening with jobs?
This is probably the biggest area of disagreement, and it's also where there's the most uncertainty. JP Morgan is pretty downbeat on the labour market. They expect the unemployment rate to peak at 4.5% in late 2025 or early 2026, and then decline only slightly, staying in the mid-4% range through the year. More striking is their job growth forecast. They're expecting payrolls to average just 25,000 per month in Q1, then sequentially recovering to 50,000 in Q2, 75,000 in Q3, and 100,000 in Q4. That's an average of only about 60,000 jobs per month for the full year, which is extremely weak by historical standards. They attribute this to the immigration crackdown, which they say is likely triggering an absolute decline in the working age population. Goldman Sachs characterises the labour market as fragile, with the greatest uncertainty. They note that job growth is running too weak to keep up with labour supply growth, which is why the unemployment rate is trending higher despite solid GDP growth. They also point out something really important. There's a disconnect between GDP growth and job creation happening across all major developed markets, not just the US. This is where productivity comes in. Both firms are seeing evidence of productivity acceleration, which means you need more GDP growth to create the same number of jobs. Goldman specifically mentions that corporate commentary shows a strong focus on finding ways to use AI to reduce labour costs.
That's a sobering picture on employment. So how are the central banks responding? Let's start with the Fed, since that's what everyone's watching most closely.
The Fed outlook is another area where we see meaningful differences. JPMorgan expects the Fed to cut rates by a total of 25 basis points in 2000, bringing the target range down to 3.2535%. They think there will be one more 25 basis point cut in early 2021, and then the Fed goes on hold, probably by spring. They note that quantitative tightening already ended on December 1st, 2025. JPMorgan emphasises that there's a wide range of views within the FOMC. At the October meeting, one member dissented in favour of no cuts, while another dissented in favour of more aggressive easing. That tells you the committee is really torn between the dual mandate concerns. Goldman Sachs is more dovish. They're forecasting two 25 basis point cuts during 2026, also bringing the rate to 3.325%. So they end up at roughly the same place, but they see the Fed as having more dovish risks. Goldman cites three reasons for potential additional cuts: their conviction on disinflation, concerns about the labour market, and the upcoming change in Fed leadership. Remember, Chair Powell's term expires in May 2026. Goldman is actually more dovish than what the market is currently pricing in.
And what about other major central banks? Europe, UK, Japan?
Let's go through them. On the European Central Bank, there's actually pretty strong agreement. Both firms expect the ECB's easing cycle to conclude in the first half of 2026, and then the ECB stays on hold. Goldman specifically says the ECB is firmly on hold at 2% through 2026. And that this will be relatively uneventful, with unchanged rates the most likely outcome. They could cut if growth deteriorates significantly, or they could hike if demand-led inflation emerges. But the base case is no change. JPMorgan agrees that the easing cycle is nearing completion. For the Bank of England, here we see a difference. Goldman is more dovish, forecasting 325 basis point cuts, bringing the policy rate down to 3.0% by the end of 2026. They expect quarterly cuts through Q3. JPMorgan doesn't give us a specific BOE forecast in the same detail, but Goldman's rationale is that labour market slack is emerging in the UK and inflationary pressures are fading. They expect services inflation, which was running at 4.4% in November, to slow significantly. On the Bank of Japan, both firms expect further rate increases. JPMorgan says the BOJ is expected to hike by 50 basis points in 2026, and Goldman confirms this, noting that the BOJ just raised rates to 0.75%, which is the highest in 30 years, and they expect further increases to the 0.75% range. Both firms acknowledge that it's difficult to prevent yen depreciation through policy measures alone, which is a challenge for Japan.
Let's shift our focus to sectors. We've been hearing so much about AI and technology. Are these firms still bullish on tech, or are we starting to see some caution creep in?
The technology and AI story is fascinating because both firms remain constructive, but with important caveats. JPMorgan is forecasting S&P 500 earnings growth of 13 to 15% for 2026, which is above the long-term trend of 6%. The Magnificent Seven specifically are expected to grow earnings by 20% in 2026. Here's a striking statistic. The tech sector accounts for 36% of S&P 500 earnings and 56% of index capital spending growth. On AI specifically, JPMorgan expects hyperscaler capex to hit $588 billion in 2026, up 29% year over year. That's AI-related physical capex running at about 1.5% of GDP. They expect tech companies to account for roughly 30% of investment-grade debt issuance in 2026 to fund all this spending. But, and this is important, JPMorgan also identifies risks. They note that elevated expectations create vulnerability. There are potential power constraints, hardware obsolescence concerns, and the pace of business adoption is critical. Goldman Sachs takes a somewhat different angle. They argue that we're not in bubble territory based on valuation metrics. They point out that when you compare the 5 largest S&P 500 companies to the other 495, the valuation difference is much smaller than in prior cycles, like the 2000 tech bubble. However, they do note that private markets show more bubble features, vendor financing, easy credit availability without proven products, while public markets have been more realistic with appropriate price adjustments. Goldman expects the AI story to broaden in 2026, moving from hyperscalers to the application layer, energy generation, and data centers. They think companies that become more productive through AI will outperform.
That's helpful context. What about other sectors? Financials, energy, consumer?
Let's start with financials, where there's pretty strong agreement. Both firms are positive on the sector. JPMorgan highlights deregulation tailwinds under the new administration. resilient earnings outlook, and benefits from yield curve steepening. They note that financials accounted for 25% of high-grade issuance in 2025, but that's expected to decline to 13% in 2026. Goldman echoes this, saying financials should benefit from lower short-term rates, but still higher long-term interest rates and economic growth. They note that banks had a tremendous year in 2025 and expect that to continue. In Europe specifically, Goldman is very bullish on banks, saying they performed exceptionally well in 2025 and should continue in 2026, catching up after more than a decade of underperformance following the global financial crisis. On energy, the picture is more challenging. JPMorgan expects traditional energy companies to struggle due to low oil prices. They're forecasting Brent crude at an average of $58 per barrel in 2026, with supply expected to outstrip demand threefold. Goldman also sees oil prices trending lower in 2026, before starting to recover in 2027. They note that falling oil prices will diminish energy company earnings, and since energy companies represent 5–10% of aggregate European earnings, this reduced Goldman's European EPS forecast by 2–3 percentage points. However, both firms see opportunities in power and utilities related to data center demand. Goldman specifically calls US power markets the best commodity AI trade, noting that US power demand is outpacing GDP growth for the first time since the 1970s, and 72% of US data centers are concentrated in just 1% of counties, creating extremely local demand boosts.
What about the consumer? We keep hearing about this K-shaped economy where higher income consumers are fine, but lower income consumers are struggling.
The consumer outlook is definitely mixed, and both firms acknowledge this bifurcation. JPMorgan notes that consumer discretionary lagged in 2025 due to tariff pressures and a softening consumer. Particularly at the low end, they point to jumping student loan delinquencies and elevated credit card and auto loan delinquencies. However, they also note that the tax refunds in the first half of 2026 may provide a temporary boost. Goldman's UK analysis is particularly interesting here. They note that consumer spending in the UK is currently low and the household savings rate is elevated. Real disposable income growth is likely to remain weak in coming quarters, but they expect the savings rate to decline as interest rates fall, which should support consumption. They're forecasting UK consumption growth of 1.3% in 2026 versus 0.7% in 2025. For China, both firms note that household consumption is constrained. Goldman specifically points out that consumer confidence has been negatively impacted by house price declines, and they expect real consumption growth to moderate in 2026. However, they expect government consumption to accelerate, offsetting household weakness. The overall picture is that consumers are under pressure, but not collapsing, and fiscal stimulus in the first half should provide some relief.
Let's talk about some specific asset classes and commodities. Starting with the dollar, what are these firms expecting for currency markets?
The dollar outlook is one area where both firms are net bearish, though with different degrees of conviction. JPMorgan has a net bearish outlook for 2026, but notes it will be smaller in magnitude than 2025. They point out that the dollar declined about 10% through the first half of 2025 and then stabilized in the second half. The constraints on further weakness are solid US growth and sticky inflation. However, they note the dollar is still about 10% overvalued versus fair value. Goldman Sachs frames their dollar view around what they call the dollar smile theory. They note that US growth expectations were firmly in the middle of the pack for much of 2025, which is the trough of the dollar smile where the dollar tends to weaken. They expect a shallower dollar descent in 2026, led by more pro-cyclical currencies. On the euro specifically, both firms are moderately bullish. JPMorgan cites Eurozone growth and German fiscal expansion as supportive factors. Goldman agrees, noting that after leading the way in 2025, the euro enters 2026 much closer to fair against the dollar. They're forecasting the euro at 1.25 against the dollar in 12 months, compared to 1.6 as of early January. For emerging market currencies, both firms see lower macro volatility, supporting EM local markets, with high yield is expected to benefit from carry. However, Goldman notes they're vulnerable if US inflation stays high or the Fed stays on hold longer than expected.
Gold has been on an incredible run. What's the outlook there?
Gold is one of the most bullish calls in both outlooks, but Goldman is particularly aggressive. JPMorgan is forecasting gold prices to reach $5,000 per ounce by Q4 2026, averaging $4,753 for the full year. They expect it to go even higher in 2027, reaching $5,400 per ounce by Q4 2027. Goldman Sachs is calling for $4,900 by the end of 2026, which is a 10% increase, and they describe this as their highest conviction commodity trade. Goldman's rationale is interesting. They cite both structural and cyclical factors. Structurally, they see higher central bank demand as the new normal since 2022, with the PBOC and other EM central banks expected to continue buying. This is driven by diversification away from sanctions risk and currency internationalization efforts. Cyclically, they expect 2 more Fed cuts to reduce the opportunity cost of holding gold. Goldman also points out an upside scenario. If diversification into gold broadens to private sector investors, there could be significant additional upside. They note that US investors currently hold only 0.2% of their portfolios in gold, and for every 1 basis point increase in gold portfolio share, there's 1.4% additional upside to prices. Both firms see gold benefiting from geopolitical uncertainty, and its role as a hedge against currency debasement.
And oil? We touched on this briefly with energy companies, but what's the specific outlook for crude prices?
The oil outlook is decidedly bearish from both firms. JPMorgan is forecasting Brent crude at an average of $58 per barrel in 2026 and $57 in 2027. They expect supply to outstrip demand by a 3-to-1 ratio in 2026, with market equilibrium achieved through rising demand as lower prices stimulate consumption and through production cuts. They note that tariffs have impacted building materials costs significantly. Steel, aluminum and copper parts are subject to a 50% tariff, but the bigger story for oil is oversupply. Goldman Sachs agrees that prices will trend lower in 2026 before starting to recover in 2027. They estimate oil was down approximately 15% in 2025 and see the market as still oversupplied due to strong supply. Goldman identifies some downside risks to their already low forecast, including a potential Russia-Ukraine peace deal and Venezuelan production recovery. On Venezuela, they note that while production was 3.5 times higher in the mid-2000s, infrastructure is quite degraded. And even with drilling restart, it takes a lot of time. For natural gas, JPMorgan expects TTF prices to average €28.75 per MMBtu in 2026, with rising LNG supply supporting lower global prices. The overall commodity picture is mixed, with Goldman expecting commodity indexes to advance as gains in precious metals offset declines in energy, similar to the pattern in 2025.
We should talk about valuations. Stock markets have had a strong run. Are we in bubble territory, or is there still room to run?
This is where the two firms provide really valuable context. JPMorgan presents some sobering valuation metrics. The S&P 500 forward PE ratio is at 22.8 times versus a historical median of 16 times. The Schiller PE is at 39 times versus a historical median of 17 times. The Buffett indicator, total market cap to GDP, is at 226% versus a median of 104%. These are all elevated levels. JPMorgan's regression analysis suggests that at current valuations, the implied 10-year annualized return for the cap-weighted S&P 500 is only 1.5%, though the equal-weighted S&P 500 implies 8.8% returns. They also note that the US is trading at a 2+ multiple turn premium to other regions, with US stocks at 12.3 times EV to EBITDA versus Europe at 8.8 times. Goldman Sachs, however, argues that we're not in bubble territory. They point out that while valuations are historically high levels across all regions, not just the US, the valuation difference between the 5 largest S&P 500 companies and the other 495 is much smaller than in prior cycles, like 2000. Goldman is forecasting a 12-month global equity return of 9% in price appreciation and 11% total return, including dividends. For the US specifically, they're calling for a 7% base case return for the S&P 500 in 2026, with a bull case of 14% at 30% probability. They note that valuations at 15 times 2026 PE are in the 71st percentile over the last 25 years. Not cheap historically, but cheap versus most other assets. Goldman emphasizes that returns in 2026 are likely to be driven more by fundamental profit growth rather than by rising valuations.
What about fixed income? Where do these firms see bond yields heading?
On Treasury yields, both firms expect a range-bound environment with modest moves. JPMorgan expects 2-year Treasuries to hover between 3.75% and 10-year Treasuries to settle between 4 to 4.50%. They have a specific Q4 2026 target of 4.35% for the 10-year. The view is that yields will be range-bound in the near term and then rebound moderately once the Fed goes on hold in spring 2026. Goldman Sachs is looking at 10-year Treasury yields around 4.9% as a central point. They describe Treasuries as the most reliable, consistent hedge in portfolios and a better deflation hedge than gold. However, they note that longer-term yields have limited downside due to good growth, large fiscal deficits, and concerns about Fed independence. On credit spreads, both firms note that spreads are extremely tight. JPMorgan reports US high-grade spreads at around 100 basis points, which is in the first percentile. the lowest in 25 plus years. US high yield spreads are around 270 basis points, in the second percentile. They expect modest widening to 110 basis points for high grade by Q4 2026. Goldman is more cautious, describing spreads as extremely stretched in the first or second percentile. They recommend avoiding carry trades like credit because of poor convexity and asymmetry when late cycle. Goldman warns that if there's a recession scare, carry trades respond very badly, and credit could underperform equities despite a positive macro backdrop. For UK gilts, Goldman expects 10-year yields to decline to 4.0% by end 2026, from 4.5% in early January. For German bonds, they expect yields to rise toward 3.25%, driven by fiscal impulse.
Let's talk about risk scenarios. What could go wrong with these relatively optimistic forecasts?
Both firms acknowledge elevated risks, though they maintain their base case for resilient growth. JPMorgan explicitly states a 35% probability of a US and global recession in 2026. Goldman's financial factor model puts recession probability at 20%, so there's a range there, but both are acknowledging meaningful downside risk. The biggest risk both firms identify is around the AI investment boom. JPMorgan notes that the boom in tech stocks and AI spending could lose its luster, even if temporarily. They point out that a shift in momentum could be triggered by a miss on mega-cap earnings, a supply crunch on power or critical materials, or an external liquidity shock. Given that AI accounts for roughly 75% of US GDP growth in the first half of 2025, a slowdown could cause a recession. Goldman echoes this concern about the labour market, noting downside risks from a more persistent cyclical weakening in the labour market. If job losses accelerate beyond the current slow hiring environment, consumer spending could contract sharply. Tariff escalation is another key risk. If the Supreme Court upholds IEEPA tariffs, and additional reciprocal tariffs are imposed with faster pass-through to consumer prices, inflation could exceed 4% sustainably, and the Fed might be unable to cut or even forced to hike. Geopolitical risks are also on both firms' radar. Goldman notes that geopolitical risk is obviously large and could put a damper on M&A activity. Cross-border M&A has not seen real recovery due to geopolitical instability. Both firms also discuss China-related risks, particularly around the property sector, and the impact of China's massive current account surplus on other economies.
Speaking of China, what's the outlook there? It seems like a mixed picture.
China is definitely a mixed story, and both firms capture this complexity. Goldman is forecasting 4.8% GDP growth for China in 2026, above consensus of 4.5%. The strength is coming from exports and manufacturing. Goldman expects real export growth of 5-6% annually over the next few years, with China successfully diversifying into non-US markets. They note that China has 20 to 40% cost advantages over key global competitors in mid to high-tech sectors and is gaining market share in global manufacturing. Goldman's most distinctive out-of-consensus view is that China's current account surplus will rise to 4.2% of GDP in 2026 from 3.6% in 2025. Looking longer term, they project this surplus will reach almost 1% of global GDP over the next 3 to 5 years, which would be the biggest surplus of any country in recorded history. The weakness in China is domestic. Both firms note that household consumption is low and constrained, with consumer confidence negatively impacted by house price declines. The property sector is in its 5th year of decline. Goldman notes that new home starts are down 50 to 80% from 2020-2021 peaks, and there's no sign of a bottom yet. They expect a further 10% drop in home prices ahead, with real prices potentially not bottoming nationwide until 2027. The property drag on GDP has been about 2 percentage points in 2024-2025 and is expected to narrow by 0.5 percentage points per year over the next few years. JPMorgan notes similar dynamics, highlighting the structural headwinds including ageing population, weak labour market, and high youth unemployment. Both firms also discuss China's impact on other economies, particularly Europe, where increased competition from Chinese exports is reinforcing structural weaknesses.
What about this idea of China Shock 2.0 that Goldman mentions? How big a deal is that for Europe?
This is a really important theme that Goldman emphasises more than JP Morgan, though both touch on it. Goldman argues that euro area economies are most vulnerable to China's overcapacity and export-led growth strategy. They describe increased competition from China as reinforcing Europe's structural weaknesses, which include demographic decline, overregulation, and high energy costs. Goldman notes that Europe has already lost market share, particularly since COVID, while China has picked up market share. They expect this trend to continue as China doubles down on export-led growth strategy. The impact on European earnings is material. Goldman notes that chemicals and autos are expected to remain under pressure due to competition and export growth from China. However, they also point out that these sectors are a small share of the Stoxx 600 market cap. And most of the European market, financials, services, commodities, has little or no China exposure. JPMorgan discusses similar themes around trade and manufacturing competitiveness. They note that China's manufacturing employment is 29% of total employment versus only 8% in the US, and China gained 21 percentage points since 1970, while the US lost 13 points. They also highlight China's lead in innovation metrics. China awarded 47% more science and engineering doctoral degrees than the US in 2023, and China's share of new clinical trial starts increased from 2% in 2009 to 30% in 2024. Both firms see this as a long-term structural challenge for developed economies, particularly in Europe.
Let's talk about some of the structural themes. Both firms mention AI extensively, but what about other structural changes like demographics, energy transition, defense spending?
There are several important structural themes beyond AI. On demographics, JPMorgan emphasizes the impact of the immigration crackdown in the US, which they say is likely triggering an absolute decline in the working age population. This is a key reason for their very weak job growth forecast. They note that very slow job growth is consistent with stable unemployment despite population decline, but it's a negative for real GDP growth in 2026 and beyond. In construction specifically, reduced labour supply is increasing costs through higher wages and reducing the overall development pipeline. Goldman also discusses demographic challenges in China and Europe as structural headwinds. On defence spending, JPMorgan highlights a major commitment. The US and all NATO members committed to spending 5% of GDP on defence by 2035, with at least 1.5% allowed for non-core items like infrastructure. Current US defence spending is 3.5% of GDP versus a Cold War peak of 6.9%. The definition of defence is expanding beyond traditional military to include energy infrastructure, supply chain resilience, critical minerals, manufacturing capacity, and cyber and AI capabilities. This represents a significant opportunity for industrials and related sectors. On energy transition and power demand, both firms emphasize the data center story. Goldman calls US power markets the best commodity AI trade and notes that power demand is outpacing GDP growth for the first time since the 1970s. JPMorgan discusses how utilities are benefiting from AI-related power needs and the infrastructure investment required for the energy grid. On supply chains, both firms discuss nearshoring and onshoring trends supporting industrial real estate and manufacturing facilities demand. JPMorgan mentions their $1.5 trillion Security and Resiliency Initiative focused on supply chain, advanced manufacturing, defense, aerospace, energy, and strategic technologies.
We haven't talked much about commercial real estate. What's the outlook there, particularly given higher interest rates?
Commercial real estate is an area where JPMorgan provides much more detail than Goldman. JPMorgan's outlook is mixed by property type. For multifamily, they see strong fundamentals and robust debt markets, with GSE lending caps increased by 20.5% for multifamily. They note there's a persistent housing supply crisis, with 22 million cost-burdened renter households. For office, it's a tale of two markets. They see selective recovery in major cities like LA, San Francisco, and Midtown Manhattan, with record rents in premium office buildings. However, lower quality office is at risk of obsolescence. For industrial, it's softer than the post-COVID peak, but remains strong, supported by nearshoring and onshoring trends, creating demand for manufacturing facilities. Retail shows solid momentum backed by strong consumer spending, with grocery-anchored and neighbourhood centres performing particularly well. They note the strongest valuations in a decade, excluding regional malls. For residential real estate, JPMorgan expects housing starts to slow to around 1.3 million, with real residential investment contracting by 1.6%. The persistent supply shortage is due to mortgage lock-in effects, elevated mortgage rates, weak affordability, slower population growth, and rising costs from tariffs and immigration enforcement. JPMorgan also discusses the impact of the 43-day federal government shutdown, which significantly impacted community development real estate, particularly CDFIs and community development entities. They note there's risk of another shutdown, which could hamper deal-making through reduced investor confidence and elevated uncertainty.
What about M&A activity? Goldman had an interesting podcast on this topic.
Yes, Goldman's M&A discussion is really interesting because it shows how deal activity has been remarkably resilient despite all the headwinds. Goldman notes that the number of $10 billion plus transactions is up 100% in 2025 versus 2024, and the last 3 to 4 months of 2025 rivaled 2021, which was one of the most active periods in history. The drivers are multiple. First, there's been a backlog of deals that were delayed during the period of higher rates and uncertainty. Second, companies have strong balance sheets and are looking to deploy capital. Third, there's significant activity in traditional cash flow businesses in industrials. Fourth, there's continued consolidation in technology, media, and telecom, driven by incredible new company formation and incredible new technologies. Fifth, there's a lot of activity in consumer retail. Goldman notes that biotech M&A continues with large-cap pharma companies looking for the next molecule. However, they also note that cross-border M&A has not seen real recovery due to geopolitical instability. The key risk to continued M&A activity is geopolitical risk, which could put a quell on deal-making. But the base case is for continued strong activity, given the fundamental drivers and the need for companies to find growth through acquisitions.
Let's wrap up with portfolio implications. If you're an investor trying to make sense of all this, what are the key takeaways from these two outlooks?
I think there are several key takeaways for investors. First, both firms are constructive on risk assets for 2026, but they're not wildly bullish. Returns are expected to be solid, but more modest than 2025, and they'll be driven more by earnings growth than by valuation expansion. JPMorgan's 13 to 15% S&P 500 earnings growth forecast and Goldman's 7% base case return for US stocks both point to positive but not spectacular performance. Second, diversification matters more now than it has in years. Both firms emphasize that international markets, particularly Europe, offer better value than the US on a relative basis. Goldman notes that European stocks are cheap versus most other assets, despite being in the 71st percentile historically. The days of US exceptionalism may be moderating. Third, within equities, quality matters. Both firms emphasize companies with strong margins, solid cash flows, and the ability to benefit from structural themes like AI. JPMorgan specifically recommends focusing on secular rather than cyclical themes. Fourth, in fixed income, the message is to embrace income. With yields at attractive levels and spreads tight, investors should focus on high-quality credit and be selective. Goldman specifically warns against reaching for yield in credit, given tight spreads and poor convexity late in the cycle. Fifth, alternatives and commodities have a role. Gold is a high-conviction trade for both firms, offering portfolio diversification and a hedge against various risks. Sixth, be prepared for volatility. Both firms acknowledge elevated risks, including recession probabilities in the 20-35% range. Having some defensive positioning makes sense. And finally, pay attention to the first half versus second half dynamic. Both firms see fiscal stimulus providing a boost in the first half of 20s, with growth potentially slowing in the second half. This suggests investors might want to be more cautious as the year progresses. The overall message is one of cautious optimism. Stay invested in risk assets, but be selective, diversified, and prepared for bumps along the way.
That's a comprehensive overview, Lizzie. Before we close, is there anything else that stands out to you as particularly important or surprising in these outlooks?
A couple of things stand out. First, the degree of agreement on the productivity story is notable. Both firms see evidence that productivity is accelerating, driven largely by AI and technology adoption. This is a double-edged sword. It's good for corporate profits and economic growth, but it means the labour market can weaken even as GDP grows solidly. This disconnect between growth and jobs is unusual and creates uncertainty for the Fed and for consumer spending. Second, the China current account surplus story that Goldman emphasises is really important and underappreciated. If China's surplus does reach almost 1% of global GDP, that's a massive imbalance that has to be absorbed somewhere. It likely means continued pressure on manufacturing in other countries, particularly in Europe, and could contribute to deflationary pressures globally. Third, the fiscal policy divergence is interesting. The US is providing stimulus in the first half through tax cuts. Germany is ramping up spending, but other countries are in consolidation mode. This creates different regional dynamics. Fourth, the power and utilities story related to AI is one of those structural themes that could play out over many years. The fact that 72% of US data centers are in just 1% of counties creates very localized supply-demand imbalances that will take years to resolve. And finally, I'm struck by how both firms are essentially saying that we're in a late-cycle environment with elevated valuations, tight credit spreads, and good growth. But that doesn't necessarily mean a recession is imminent. The cycle can continue for a while in this optimism phase, but it does mean investors need to be selective and not chase the riskiest assets.
Well, we've covered a lot of ground today, from GDP and inflation to specific sectors, from currencies and commodities to valuations and risks. The bottom line seems to be that both JPMorgan and Goldman Sachs see a resilient economy in 2026, with opportunities in equities, particularly in quality names and structural themes like AI, some value in international markets, attractive income in fixed income, and gold as a portfolio hedge. But there are real risks around the labour market, tariffs, geopolitics, and the late-cycle nature of the expansion. As always, these are forecasts from major Wall Street firms, and the future is inherently uncertain. Remember, do your own research and consult with financial advisors before making investment decisions. Thanks for joining us on the Weekend Market Review. I'm Robert, and Lizzie, thanks as always for the deep dive into these reports.
Thanks, Robert. It's been a pleasure walking through these outlooks with you.
And to our listeners, thank you for joining us on the Morning Bell. Until next time, have great returns in 2026. Don't forget to subscribe to get daily, concise, and unbiased market insights.